15 seconds. Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Jeff Dorman. He's Chief Investment Officer over at Arca. We're going to discuss the Ethereum Merge and why it could be one of the most important crypto events of the year. Jeff, it's great to see you as always. Welcome back to Trade Talks.
Thanks for having me.
You got it. Let's start with the basics. What is the Ethereum Merge and why is it such a big deal?
Sure. So Ethereum is currently a proof of work chain, which basically just means that dedicated computer nodes called miners compete to solve a cryptographic puzzle to ensure the security of the Ethereum blockchain. After the merge, it's moving to a proof of stake system, which basically just means that nodes will instead post collateral to secure the blockchain at risk of losing what they're staking if they lie or if they don't if they're not honest about what they're validating. So essentially, you're moving from what was more of a random process with as many computers on the network as possible to now those have to put up an actual economic stake in order to participate in those inflationary rewards.
Why is this the most important crypto event of the year, and when do you expect it to take place?
Sure. So right now, the block is somewhere around September 13th is when it's actually going to take place. The reason it's so significant is from a technology standpoint. There's been a lot of talk about ESG and about the cost of proof of work mining. Obviously, moving to proof of stake, that's a much more environmentally friendly type of blockchain. But also, this is just part of the long-term path for Ethereum 2.0, which is really just the beginning of the roadmap, which is ultimately meant to help Ethereum reach sufficient scalability and security in order to onboard millions and potentially billions of users over time. From an investing standpoint, it's even easier to quantify whether it's such a big deal. Currently, under the proof of work system, there's about 13,000 ETH per day that go to miners. So you can think of that as the inflation of the Ethereum network, right? It's about $21 million at today's prices. So $21 million today goes to miners, and most of that gets sold, right? Because miners are mercenaries. They have to sell the Ethereum that they're mining in order to offset their costs. Well, post the merge, the inflation is only going to be 1,600 ETH per day, which is about $2.5 million per day. That's an 88% reduction in these inflationary rewards. So, all else equal, if you assume demand is constant for Ethereum, but your supply is now dwindling by 88% per day, that should have a pretty positive impact on price. And even further, if you just look at the average fees that the Ethereum network generates with all the applications and all the usage that happens from your NFTs, your gaming, your DeFi applications, your stablecoin transactions, et cetera, right now, over the last 90 days, Ethereum has averaged about 2,000 ETH per day that has been burned. So that basically means that ETH will become deflationary, right? If there's 2,000 ETH per day being burned and only 1,600 ETH per day that are being given out to validators of the network, you effectively are reducing the total supply of Ethereum every day. And if economic activity increases even further, that gets even more crazy. So I think that the day of the merge itself probably comes and goes with very little fanfare. But when we look back 6 to 12 months from now, you're going to say, oh, well, that was obvious why Ethereum is way higher than it is today, because there's way less supply and there's just as much or more demand.
So is there anything I need to do ahead of the merge with Ethereum you hold in your account now? Do you expect the process to be seamless? What happens with the old tokens?
Sure, yeah, and I might be dating myself here, but a lot of this reminds me of Y2K. Back when the calendar flipped from 1999 to 2000, everyone was freaked out about what would happen with computers and the dates. And then, of course, it came and went and nothing happened. Behind the scenes, there was tons and tons of developers who were working on it to ensure that Y2K became a no big deal. That's the same thing that's happening with the ETH 2.0 merge. Regular users and developers don't have to do anything. This is actually a pretty seamless process because the Ethereum community and the developers have worked so hard over the last few years to ensure a smooth transition. The process will be smooth and seamless. Old ETH tokens will be replaced by the new ones. There's really no concerns that we've heard of in the last few months that are really that we can validate in any way, shape, or form. We think this date comes and goes, the block happens, and we're on the new chain and off and running.
And Jeff, let's talk a little bit more macro in the crypto space, if you will. Do you think that the crypto contagion is over? There certainly were a number of high-profile events this year.
Yeah, this has not been a shortage of news in the digital asset space for sure. Yeah, I mean, I'm a little bit lonely on this island, but I think digital assets have largely decoupled from macro, and that happened right around June. Now, I don't include Bitcoin in that. I think Bitcoin is still very much a macro asset. I think Bitcoin has lost a lot of its narrative recently. It hasn't been an inflation hedge. It hasn't been defensive. It certainly isn't being used as a medium of exchange. And as a result, I think Bitcoin is more of a macro asset than ever. It's basically like a 24/7 VIX or just an extension of the Nasdaq. But the rest of the digital asset space has much more idiosyncratic factors that are driving prices. Everything from the Ethereum 2.0 merge that we just talked about, to there's a lot of reorgs and restructurings going on right now. Even the Terra Luna blockchain has just recently restructured. There's some DAOs that are liquidating. There's some M&A activity. There's a lot of governance proposals. Typically, what you see in bear markets is you see better structured deals, right? This is true of the debt and equity markets as well as in digital assets. We saw the same thing in 2019. Most of the really good tokens that exist today were issued in 2019 during a bear market because they had to have better tokenomics. They had to have amortizing structures. They had to have warrants attached or other ways to accrue value. And that's what we're seeing today. So if you look back to June, or really, I guess, mid-July, when broader risk markets started to bottom and start to move back up, it looked like it was all highly correlated. It looked like it was just around the Fed pivot, but really it was because this is when the Ethereum 2.0 merge date was set. This is when we started to see governance proposals being issued. And I would argue that most of digital assets are now following their own path and no longer being beholden to, every word out of a Fed governor.
All right, Jeff, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.